The 360 on Energy and Carbon, hosted by 360 Energy. On today's episode, we are joined by Stephen Schork. Stephen Schork is a highly acclaimed speaker who is widely recognized for his ability to integrate vast arrays of compelling information into dynamic and succinct market views. His presentations include overviews of the most pressing issues affecting the energy sector and context within which to evaluate market action. Now let's get into the episode with Stephen. Welcome back, Dave and John.
Great to be back.
Today we're joined by Stephen Schork, principal and co-founder of the Schork Group. Welcome back, Stephen.
It's great to be back. Thank you.
Stephen, I'm so pleased to have you here with us, a seasoned pro, an expert that I think I'm not sure if all our listeners are aware of, but if you Google Stephen and his expertise, you'll see the vast knowledge he has. So I'm going to start off with the first question. And so my question to you is, how should energy companies hedge their strategies during these extreme price volatility, with periods of extreme price volatility and such as what you've seen in recent years? How should they adjust that as we go forward?
It's a great question. They should adjust it by hedging when we don't have extreme volatility. And that is isn't that the adage? I did a talk in Vienna during the run-up in 2008. And it was when oil prices were at their highest. And a week before, Lufthansa came out and had hedged all their jet exposure. And the joke was that, now that Lufthansa's hedged their exposure, energy prices are going to come crashing down. And certainly they fell about 90% over the next 6 months. So you should have an active hedging program. And we did touch upon this in the last call, that each company has very unique hedging programs. And it all is based on the individual. And the individual knows themselves, and each individual has a risk tolerance. And that risk tolerance comes from you naturally. Companies also have a risk tolerance. Some companies are more aggressive and willing to take on risk, and some companies aren't. So it depends on the environment. It's been my experience, companies dealing with end users in the Midwest, they have a very Midwestern sensibility, a very conservative sensibility. So they're not big believers in hedging in any sort of market environment. And then you have other companies that will be more dynamic. So you have to look at companies, they all have a different incentive program. I was amazed one time, I was doing a hedging seminar with a large oil and gas producer, and we ran a game. They had about 10 of their customers, all end users, in the room, and we went through market scenarios, and I gave them certain scenarios, and I gave them an ability to hedge at certain different products and how they would execute in the real world. And if you had 10 different tables, you had 10 different responses. And it depended on what kind of company they were from, their management, their incentive program. Some companies only wanted to make budget. Some companies, the person making the decision shared in potential profit of how much money they saved. So in extreme volatility markets like this, your best answer is to go ahead and look at options positions, buying insurance. And this is, you all have health insurance. We all have insurance on our homes, insurance on our cars, and so forth. You should own insurance on your price risk. And that is what an option is. It gives you the right to execute at a certain price if we hit that certain price. So we work with companies. We identify what is your budget, wherein are you happy buying gas or happy selling oil? Let's set those parameters. You'll pay a premium, and sometimes you don't even have to pay a premium because you could put on a position called a collar where you buy an option to protect against upside risk. You sell another option on the downside. You're happy being executed on either side of that risk. And the option you've sold, that premium you collect, pays for the premium you bought. So you could actually put on a hedging program that's not going to cost you anything, and it will lock in your exposure. But when I propose this to hedgers, they all get it immediately, but they all have to run it up the management chain, and sometimes the management will respond accordingly and take action. And oftentimes, though, the management doesn't want this risk. They see it as a risk. So with extreme volatility like this, companies should recognize that they're risk. I want to preface this with an extreme volatility. They shouldn't be hedging at this moment. They've made the decision. They're going to have to wait for a more volatile market because now the cost, even if you're doing it costless, your risk parameters are so great that you've really mitigated any sort of potential upside. So the takeaway here is hedge when volatility, as it was over this summer. This is when your dynamic hedging program should have been established. Right now, you're going to have to pick your spots and go with God.
So are you describing like a zero cost collar? Is that kind of what you're describing?
Yeah, absolutely. There's zero cost collars. There are, depending on your swap dealer, there are participation swaps where you could lock in your price and then you can pay a little bit of a premium and the price goes in your favor. You could partake in that. You could establish your swap by selling a call above it. So you've collected some premium, and if you get called out, you've sold the call at a level where you're still happy of owning or selling, I should say, that at that price. So there are all sorts of different dynamic programs. Some you'll pay a premium, but as you correctly pointed out, something like a zero costless collar is a very popular tool to help mitigate risk.
And one last question. I was asking it specifically for energy companies, but as far as these large industrials, is that happening very often as well, looking at that type of activity?
Yes and no. So I've recently talked with two very large steel producers, and one, their hedging program is absolutely stunning. They hedge every aspect. I mean, steel is what you're doing. You're melting rocks. So there are a lot of different commodities, beginning with the rocks are actually melted to the BTUs you have to purchase to melt those rocks. So it's a very heavy, intense commodity trading company, physical commodity trading company, as it were. And one company, they have a team dedicated to hedging every aspect of the commodities that they have exposure to. The other producer, no. They have a very small team, a very young team, a very inexperienced team, and they're essentially just locking in their exposure when the CFO tells them to lock in the exposure. So some companies are very dynamic, very impressive in managing their risks, and some companies are just basically rolling the dice.
Yeah, that's interesting. Now, your approach to benchmarking past projections against current market activity has earned you great respect. So could you walk us through your process of evaluating the accuracy of past forecasts and how that helps you refine future predictions?
Yeah, absolutely. So since 2005, I've produced a daily research note. So it's a note that goes out about approximately 20 trading days a month, times 240 a year, times almost 20 years doing this. So there's no hiding from me. So when I go out and establish position, I go on a podcast or I go on Bloomberg Television or whatever, and I do give an opinion on pricing. I'm answerable to it every single day on the following day. So from a benchmarking standpoint, we're looking at either daily, weekly, monthly, and seasonal price projections. So I go ahead on each day, and in the daily report, I will go ahead and say, okay, it's reached these parameters, we add more, or it's violated this. And so I explain every single day just how well or just how poor the model is doing. And this is it. A model is a living, breathing entity. There's no one model that is just fixed. Every model has to be adjusted. So every day is a little bit of more information that impacts the model, and then you learn how to use it, either on the daily basis, on the weekly, and on the seasonal basis, most importantly, and the way hurricanes used to impact the market. So my approach to looking at forecasting hurricanes has changed greatly over the past 20 years because fundamentals have changed over the past 20 years. But the bottom line, as far as benchmarking is concerned, you learn every single day. You accentuate what works for you. You mitigate what's not working for you. And most importantly, you explain it to your clients that I don't have a crystal ball. I'm using statistics. I'm using intuition. I'm using 30 odd years of experience, but I certainly don't have an ironclad answer to each how everything's going. So what I like to do from a benchmarking standpoint, and this is what I think quantitative analysis is so important, is because it's giving you the statistics on the probabilities of a market reacting a certain way. And this is how we benchmark. When my statistics are violated, it's not necessarily a point, well, oh, it's violated to the upside. We're expensive. I'm going to sell, waiting on that mean regression. It's violated that parameter because something in the statistics did not catch something fundamentally changing in the market. So that's where we jump off. And my first reaction is, why did the model fail this time? What underlying fundamental has changed? So the way we go about benchmarking is it's on a daily basis. So I have to explain to the client, to the reader, what worked, what didn't work. And then I have to go figure out, okay, the model failed. What changed in the market? And it keeps you honest every single day when you get in front of someone to explain what's going on.
So it helps build trust, doesn't it?
Absolutely, right? How many analysts, for instance, when oil prices went negative at the start of COVID, how many analysts saw oil going to minus $60 a barrel? I certainly wasn't one of them. And if you claimed you did see that, well, please show me your P&L and show me all the money you made on this. So
You should have made a lot.
Yeah, it absolutely keeps you honest. I'm the first to admit I would have loved to have sold oil at $40 a barrel and buy it back at minus $60 a barrel. I didn't do it. And in fact, I got a phone call from a colleague on that Friday night. Now, this occurred on Monday, but that preceding Friday night, I got a phone call at 11 o'clock at night on Friday from someone telling me, I hear that the NYMEX is starting to price negative puts. I had no idea what he was talking about. A negative put meaning that you could buy oil at negative prices. I didn't even know what he was talking about when he said negative puts. So it certainly was a learning experience. And I'll be the first to admit that I did not see that coming. And yes, it does build a sense of trust. And doing this for 20 odd years and the public exposure, I've been very fortunate to enjoy. It does keep you honest and it does build up that sense of trust. And hence why with our client, we have a very low attrition rate because you're going to get exactly what I think. And I'm not going to beat my chest when I'm right because I've been wrong and I know how it feels to be on the wrong side of the trade. So it's just, let's keep it smart and keep it simple and let's take each day as it comes by.
Thank you.
Stephen, as the world moves towards renewable energy and decarbonization, how have your methodologies adapted to the structural changes within the energy market?
Yeah, that's an excellent question. And this is a great segue into where the quants work. For instance, looking at Texas this past summer. Now, the people that live in Houston don't want to hear it, but this summer wasn't that hot, relatively speaking. Of course it was hot. It's always hot in the summer in Texas. But again, especially related to a year ago. Now, when I ran the fundamental models, gas usage in Texas was lower than I had really anticipated. And what I was really anticipating was that, or what I failed to anticipate, I should say, was the impact that solar made in Texas. Now, renewables in Texas are huge. Texas is a major producer of renewable wind energy. And we've seen over the past 10 years how wind has really impacted ERCOT. And at certain times of the day and certain times of the season, wind is a major factor when you have normal weather. When I say normal weather, I'm not talking about a Hurricane Harvey or that winter freeze we had a year ago where wind contributed to a lot of catastrophe in the ERCOT or the Texas power grid. But you have to kind of start to meld in all these new variables. And any sort of economic model, there are two variables, I should say, that impact consumer behavior. Now, up until the past 10 years ago, we've only had one of those factors, and that was price shocks. So going back to the oil embargo in the early 70s, through the Iran-Iraq war, through the 1980s, Saddam Hussein's invasion of Kuwait, so forth. Up until recently, we've always had those price shocks, both up and down. And yet, that really never could impact consumer demand because we didn't have the other variable. And that, of course, is a substitute. There was no substitute for gasoline or diesel fuel up until 10 years ago. And now we have that. So it's an ongoing process. And no one really has an answer to this. So 10 years ago, I could tell you with a surety that $3.60 at the gasoline at the pump was the inflection point. That was the point. You adjust that going back to the 1970s, adjusted for inflation, up through 2009, $3.60, what was your inflection point? That's when consumers began to respond to price. And that's when consumers' behavior began to change. So now with what has transpired in the past 10 years with EVs, or more importantly, plug-in hybrids, which I own one, we have that variable that has changed. We have substitutes into the market. I'll give you a personal anecdote. I have a 17-gallon midsize SUV. It's an electric plug-in hybrid. But on those 17 gallons of gas, I get a minimum of 700 miles before I have to go back to the gasoline station. I've actually gone over 1,500 miles on that one type of gas before I've had to replace it. So today, and everyone who drives a plug-in hybrid really doesn't care about the price of gasoline. So there is no more inflection point of how consumers will change. That's the first variable that we're all trying to figure out. Okay, what is that point where elasticities of demand will change? And of course, the other huge impact now is what we've seen post-COVID. Once again, up until 10 years ago, regardless of the price of gasoline, I had to pay it because I had to drive to the office. I had to drive the kids to school. I had to do these things. Now, working from home, many of us do, or could just go into the office twice a week. Once again, our demand has changed both from substitutes and our travel patterns. So this is an ongoing event. So as we said, this is why we benchmark ourselves, because going in, I went back and did the postmortem. Okay, why was gas demand much weaker than I thought it was going to be, taking weather and wind into consideration? And I did not take into the impact of the amount of solar that impacted. So that is a known. The known unknowns are dispatchable BTUs. So nuclear, coal, natural gas, this is dispatchable. I could turn a switch on and I could start burning natural gas and start to create electricity. But if the sun's not shining or the wind's not blowing, I don't have that variability. So while renewables are making it a positive impact in a dispersion of our exposure, it's also giving you greater risk because they're not on-demand BTUs. So it's an ongoing process that we're all learning to adjust our models for.
I want to just add to that, Stephen, is that now with storage capacity, whether it's battery storage or they're talking about significant air storage for renewable energy, it's going to evolve where you will have storage available for electricity. We'll even complicate the model even more so going forward for people like yourself. So,
yeah, absolutely. And we're seeing it in Texas doing the postmortem. So we had X amount of solar coming to the market. And by 2025, we'll have more solar and, to your point, battery storage, which will come. So it's all evolving. But I also want to make the point here that fossil fuels are not going away. And the biggest risk, and this will be one of the biggest takeaways, is that the powers that be have put forth an energy policy in the United States that is unattainable. So we've set our goals for zero emissions that are beyond reality. And this is an opinion. This is talking to people at PJM, which aggregates and distributes power for the better part of the upper right quadrant of the United States. We have federal regulators that are saying that we don't have enough renewables into the market that are going to be able to cover the loss of coal and natural gas, and up until recently, nuclear that has been codified that has to be taken off the books. So we are going into an extremely volatile next few years because the powers that be, the federal government or the retail transmission organizations that have to distribute this power, are saying we don't have enough generation. So this is a significant problem. And so what happens and what is happening is, I think Mike Tyson said it best. Everybody has a plan until they get punched in the face. So the government had a plan up until a couple of years ago, or I should say up until a year ago. That plan was we were going to codify and take every fossil fuel generator out of the market. Well, the government's getting punched in the face right now because we cannot do that. We are not building the renewables, battery storage, solar, so forth. We're not building it fast enough. So what has happened over the past year? We're switching to what we should have been switching to years ago, but the market has now forced the hand and we're going nuclear. And so we have the first mothballed nuke that just got a $1.5 billion loan from the Biden White House to restart a nuclear station in Southwest Michigan. News just broke a couple of weeks ago that Microsoft is building a data center and they're restarting the 3 Mile Island, a nuclear station in my home state of Pennsylvania. Now, mind you, not the reactor that had the meltdown back in the 70s, but the reactor that was just retired a couple of years ago. They're restarting that. So we're seeing a tremendous amount of growth in data center and the growth of AI, which requires a tremendous amount of electrons that we just simply don't have enough renewables for. So what the market is forcing and where we're growing is we're getting off of this non-binary. Well, we've been on this binary track where I have to codify, I have to kill a gas plant because I want to build a solar plant. That cannot happen, and the market is learning that quickly. So we are shifting. Hopefully, natural gas is no longer the dirty word it was 5 years ago. Nuclear is no longer the dirty word. So the market is slowly but surely is changing, and I do believe changing in a positive because it's given us greater variability on how we generate our electricity. And it's better for the environment, I should say also.
It's a great segue for the next question, and that is, with AI being adopted and across various industries, how do you see its role in the energy trading?
Yeah, it is right now in the here and the now. It's made my life a lot easier going back and instead of culling through 20 years worth of reports, as I said, 240 issues a year. I'm starting to incorporate AI in just my own daily outlooks. Now, it's not there yet, but it does give me, it probably has shaved 2 to 3 hours a day off of just my analysis of being able to access how I looked at things 5, 10, 15 years ago, so forth. So that certainly is going to grow. And as far as trading, that's really interesting because you can foresee AI programs taking over trading and hedging programs. Now, and I'll give an example that probably up until I might have the timing off, but there was a point where grandmaster chess players never thought, and it was thought that a computer could never beat a master because of the computer lacked intuition. And the computer couldn't foresee not making the most optimal move in chess. And so it was thought that a chess player of that caliber would never lose to a computer. That has changed. The computer, the supercomputer, the power to compute all these calculations has changed, and its ability to make all of the mathematically correct decisions. And so now you do have computers that do beat grandmasters. And this is all what hedging and trading is. It's a chess game. So if you could beat Gary Kasparov in chess, you could beat the finest oil trader as well. And when you take the ability to compute all of the correct mathematical decisions and then add AI, a bit of intuition into it, you could foresee in the not too distant future AI coming in and hedge funds or large commodity trading companies or even state-old aluminum smelters that want to introduce AI into a hedging program. You could see that taking off over the next number of years. I don't think that's a far-fetched idea here. We've seen it in the chess world. We'll see it in the trading world.
So what I'm hearing or grasping based on what you're saying is, because in the previous podcast we talked about that perhaps the hedging strategy isn't as active as it should be, this AI capability might allow more hedging in the marketplace that isn't there currently. Is that where you think it's going to go or could go?
Yeah, absolutely. It's a great point. Absolutely. So if you could have an AI generated program given certain parameters, and here's the bid and the ask, and you can go to your senior management and they could watch it in real time and say, and you could have all of the risk parameters laid out, the potential upside and the potential on the downside. I do think that this is an opportunity for industry, not just traders, but industry in general, to bolster their hedging programs.
Stephen, thank you so much for another great episode. To end off this episode, what is your biggest takeaway for our listeners?
Yeah, I went into it a little bit before. It's important that we go through and adopt a all-inclusive energy policy in this country. I'd like readers to go back and read the Democratic National Platform in 2012 when President Obama was running for re-election. And when you go back and you read his platform, he was all in on natural gas. He was all in on nuclear, on clean coal. These were all in his platform, as well as, of course, expanding renewables. We need an all-in policy. Up until 5 years ago, as I said, the United States had the greatest comparative advantage. We were the envy of the industrial world with our access to the cheapest natural gas, electricity, oil prices that no one could really compete. And there were numerous studies. I believe the University of Michigan put out a study highlighting the comparative advantage that cheap energy has given us. And it's given the industry and it has given people hope. I have clients up in the Monessen area north of Pittsburgh, where J&L Steel, when they closed in the 1980s up there in Aliquippa has been an economic graveyard for the past 2 generations. Well, a number of years ago, Shell built an ethylene cracker there, and you're restoring hope and economic opportunity to communities that have been left behind over the past 30 years. And we were going in that direction up until fairly recently. So I think the biggest takeaway is we need a little bit of everything. We need nuke, we need natural gas, as well as we need wind, we need solar. We need to take advantage of every single opportunity we have to get this country back to a policy that is both good for the economy and good for the environment. Because I want to be very clear in here that renewables are not, that there are tremendous pitfalls with renewables from an environmental standpoint. When we talk about the amount of earth we have to scratch up to get to the rare earths, the countries that supply rare earths now, the metals, in the Congo, which doesn't have the greatest record of human rights, China, again, doesn't have the greatest record of human rights, as does Russia. This is where a lot of these rare metals are coming from, and there is a social cost there. So there are costs for renewable. That doesn't mean we shouldn't be growing them and exploiting them, but it does mean we shouldn't be doing it exclusively to the detriment of growing our other assets to take advantage of. So I think that is, going forward, a more inclusive energy policy is the most important takeaway we can be focused on right now.
Thanks for that, Stephen. John, what's your biggest takeaway?
I want to actually say that what Stephen said there, I think, is something we've heard, and I'm not decrying it with this, we've heard this before, and it's a message that people miss. There isn't a binary single solution to energy and the environment, and it has to be a mix of things. But there were a number of things that went through my head whilst we've done this session, and I think the one that hit me was that I've been in the energy and sustainability sector for a long time, and I've realised I don't know anything much about hedging. And I think this is where we need to have diverse teams of people involved in these things. Because if you think you're going to handle it all purely from the technology point of view, you're not. Markets are there. We're in market-driven economies. And if you haven't got somebody who understands how markets work, then, you're not going to be successful.
Thanks for that, John. Dave, what's your biggest takeaway?
I think my takeaway is that effectively that for countries, for companies, that energy should be a binary thought process in their strategic direction and implementation. And as Stephen conveyed, in North America, we have a huge opportunity because of the abundance of energy and the low cost in comparison to other jurisdictions. And we should be taking advantage of that and going forward taking advantage of that. And I think often, whether it's Stephen or other people that we speak to, it's always treated as a silo or as a fringe thing that someone has to deal off on the side. And I think we were strategic as a country or countries and companies. I think we could really make it a strategic advantage to the organization and country. And I'm not sure if that's there right now. I could be missing that, but that's my belief.
All right. Well, thank you for another great episode, Dave, John, and Stephen. Have a great day.
Thank you, everyone.
Thanks for being.
Been brilliant. Thank you.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn posts. See you next week.